Welcome back to the deep dive. Today we're looking at something quite specific, aren't we? A company maybe not everyone tracks daily.
Yeah, exactly. We're zeroing in on Tourism Finance Corporation of India Limited, TFCI. It's a highly specialized player in the Indian financial market.
Right, TFCI. And this isn't just, a quick glance. We're really trying to connect the dots here based on their latest disclosures.
That's the plan. We want to cut through the noise of their H1 FY26 results. That's for the half year ending September 30th, 2025, and really distill what they're about.
So the goal is, by the end of this, you listening should have a pretty clear picture of TFCI, how they operate, how they're evolving, and, well, what the numbers actually say about their health.
Yeah, a quick, informed understanding. And our sources for this are mainly the unaudited financials reviewed by their board on November 10th, 2025, plus a pretty detailed investor presentation they put out.
Okay, good. So diving in, what really jumps out first is their history. This isn't some new fintech startup.
No, not at all. They have a serious track record. We're talking over 36 years in the business.
36 years. And historically, they've really dominated a particular niche, right?
Absolutely. That foundation is built on specialization. For decades, their main game has been hospitality financing. Think of them as the go-to lender for tourism infrastructure projects in India.
Okay, hospitality financing. What does that actually mean in practice? Are we just talking about funding big five-star hotel chains?
It's actually broader than that and seems quite tailored. Their core lending is term loans, but it covers like the whole ecosystem.
Right.
Setting up traditional hotels, yes, but also resorts, motels, even more specialized stuff like spa or health resorts, apartment hotels, guest houses. And they specifically mention restaurant chains too.
Interesting. So it sounds like they cover the whole life cycle of these projects, not just the initial build.
Exactly. They're not just there for the ribbon cutting. They provide funding for that crucial last mile to complete projects.
Oh, okay.
They also finance major expansions, modernizations, renovations, even acquisitions. And importantly, they mentioned taking over existing loans.
Refinancing, basically.
Yeah, refinancing, often with elongating the loan tenure and sometimes adding a top-up amount. It shows they're pretty active in managing debt within that sector. They know it inside out.
With that much deep industry knowledge over 36 years, I imagine that's valuable beyond just writing checks for loans. I noticed they mentioned advisory services, too.
It's a really good point. It's a key part of their model, actually. Beyond the direct lending, they have these supporting income streams.
Huh?
One is managing their own risk through debt syndication, selling down parts of loans. But the other, the advisory side, is significant.
How so?
They leverage all that experience, 3.5 decades, to offer things like project feasibility reports, market surveys, basically turning their specialized knowledge into fee-based income.
Which is lower risk than lending, I guess.
Exactly. It diversifies their revenue away from just relying on their balance sheet and credit risk. It's smart.
Okay, so that's the foundation. Deep roots in tourism. But the story, especially looking at these H1 FY26 results, seems to be about moving beyond that core.
Definitely. Hospitality is still the biggest chunk, about 60% of their loan portfolio as of September 30th, 2025. But they are actively and, it seems strategically, diversifying.
All right, let's unpack that diversification. Where are they moving into?
Well, they seem to be targeting areas with pretty secure, stable cash flows. The biggest move outside hospitality is into the real estate sector. That's about 12% of their portfolio now.
Real estate can be risky, though. Are they funding speculative high-rises, or is it more specific?
From the presentation, it looks very deliberate. They're focusing on construction finance, specifically targeting affordable and middle-income housing projects.
Okay, that sounds less speculative.
Yeah, and also niche things like builder floors in Delhi and Gurugram. Plus, a big one is lease rental discounting, or LRD.
LRD, that's lending against existing rent contracts, right?
Exactly, lending against future, already committed lease payments. Yeah. So very secure cash flows. They do mention commercial real estate, but only on a selective basis. It's not the main focus there.
That does sound very measured. Prioritizing steady residential development and proven rental income streams. Okay, so that's real estate. What about the other, 20-something%?
Another roughly 13% falls under a category they call manufacturing, social infrastructure, and logistics.
Quite a mix.
Yeah, it's basically funding, the broader economic engine. Things like established manufacturing units needing funds for expansion or working capital.
Makes sense.
And then essential social infrastructure, think education, healthcare, like hospitals or nursing homes, plus logistics assets like cold storage facilities.
And I saw renewables in there too.
Right. They're also funding captive solar and other renewable energy projects. It fits that infrastructure theme.
Okay, and then there's this other piece, lending to other financial institutions, NBFCs, ARCs. That sounds potentially higher risk.
It could be, but they seem very careful about how they do it. There are specific security measures built in. About 5% of the portfolio was in the NBFC sector and 3% in the ARC, or Asset Reconstruction Company, sector.
So how do they manage that risk?
Well, when they do co-lending with NBFCs to sort of dip their toes into retail lending, it's strictly focused on secured loans, SME loans, and especially loan against property, or LAP.
Okay, let's pause there. For listeners maybe not familiar, LAP, loan against property, that means?
It just means the loan is secured by real estate collateral. So if the borrower defaults, there's property that can be sold to recover the funds. Much lower risk than, say, an unsecured personal loan.
Got it. Safer. And what about the ARCs, the asset reconstruction companies?
Similar principle. When they finance ARCs, they require the underlying security receipts, the SRs, to be backed by a minimum RR1 rating.
An R11, in simple terms, means?
It's basically the top-tier rating for security quality on those instruments. It signals very minimal credit risk. So yeah, whether it's NBFCs or ARCs, TFCI only seems to play if they can get really strong clarity.
Very disciplined approach across the board then. Now, looking forward, perhaps the biggest strategic shift mentioned is this move into alternative investment funds, AIFs.
Yes, this is potentially a game changer for them. It's a move away from being just a direct lender. TFCI has received in-principle approval to act as a co-sponsor and also an investor for a Category 2 AIF.
And this AIF will focus on?
Their core areas,
Yeah.
naturally. Hospitality and real estate. This isn't just another loan product. It's a different business model almost.
Why is co-sponsoring an AIF potentially better strategically than just making more loans directly?
Well, think of it as shifting from being capital intensive to more fee intensive. As a co-sponsor, yes, they'll commit some of their own capital, but the big win is earning management fees on the entire fund size.
Ah, leveraging other people's money, essentially.
Exactly. It generates a potentially steadier, higher margin income stream.
Mm-hmm.
And it does that without putting their own balance sheet at risk for every single deal in the same way direct lending does. They're leveraging their expertise for structured finance income.
Okay, that makes sense. A potentially powerful shift. So that's the strategy: diversification, focus on security, and this new AIF initiative. How did this all translate into actual performance in the first half of the fiscal year? Let's get into the numbers.
Right. The H1 FY26 results. And they do look pretty strong compared to the same period last year, H1 FY25.
Okay.
Total income was up, reached Rs 132.30 crore compared to Rs 126.47 crore. But what's more impressive is the jump in profitability.
Meaning costs were well managed or margins improved?
Likely both, but especially margins, which we'll get to. Profit before tax, PBT, saw a really healthy increase, Rs 74.72 crore, up significantly from Rs 64.18 crore.
Okay.
And that carried through to the bottom line. Profit after tax, BAT, came in at Rs 59.62 crore, compared to at Rs 51 crore the previous year.
So a noticeable improvement in profitability, and that means better returns for shareholders too, right? EPS?
Yep. Earnings per share rose to Rs 1.29, up from Rs 1.2 in H1 FY25.
Yeah.
Clear improvement.
Yeah.
But the number that really stands out is their net interest margin,
Yeah.
NIM.
Ah, yes, the NIM. What did that look like?
This is where you really see the strategy hitting the profit and loss account. They reported a NIM of 6.20% for this first half.
6.2%. Wow, that's quite high, isn't it? How does that compare?
It's a huge jump. For the entire previous fiscal year, FY25, their NIM was 5.07%. So jumping over a full percentage point in just 6 months is substantial.
That is a massive leap in profitability on their lending activities. What drives that kind of improvement so quickly?
It seems to be a direct result of that diversification and portfolio cleanup we were just talking about. They appear to be shedding older, maybe lower margin assets.
Which we'll touch on with asset quality soon.
Exactly. And replacing them with these higher yielding but still secured products in real estate, the specialized lending, those co-lending deals, the LRDs. They're just getting more bang for their buck from their funding base.
Okay, makes sense. And while improving margins, they also managed to grow the overall business size.
They did. Steady growth. Gross assets under management that includes their loans and also NCD investments rose to Rs 1,905.91 crore by the end of September 2025.
Up from
Up from Rs 1,693.57 crore back in March 2025. So solid expansion. And importantly, this growth is supported by a rising tangible net worth, which hit Rs 1,241.72 crore.
Okay. And just quickly, geographically, where is this lending concentrated? They mentioned the total gross loans were over Rs 1,850 crore.
Yeah, they highlight three key states holding the largest chunks. Maharashtra leads with about Rs 394 crore, then Uttar Pradesh with nearly Rs 350 crore, and Gujarat with around Rs 309 crore.
Any reason why those three states are the hotspots for TFCI?
It looks like a good mix that hits their strategic targets. Maharashtra obviously has major financial centers and commercial real estate hubs.
Right.
Uttar Pradesh is seeing huge growth in infrastructure and tourism development that plays right into TFCI's core expertise and their newer infra focus. And Gujarat provides a strong base for manufacturing and industry, fitting that other diversification bucket.
So they're putting their money where the growth aligns with their strategy. Makes sense.
Seems that way. Calculated bets in high-growth, relevant markets.
All right, strategy sounds good. Growth is there. Profitability is up. But for any lender, the absolute key is asset quality. You can make great profits on paper, but if your loans go bad, it all evaporates. So what's the story on their risk profile? This is where it gets really interesting, you said.
Yes, this, for me, is the headline story from these results. The improvement in asset quality is, frankly, spectacular.
Okay, how spectacular.
Their gross non-performing loans, gross NPLs as a percentage of their total loans, dropped sharply, down to just 0.22%.
0.2%, that's incredibly low. What was it before?
For the full previous fiscal year, FY25, it was 3.22%. And even in the first half of that year, H1 FY25, it was 2.82%. So a massive improvement.
Wow, okay, that's almost negligible gross NPLs, but the number that really made me pause when I looked at this was the net NPL figure.
Get this, net NPLs are reported as nil. Zero.
Zero. Seriously. How does a lender even achieve zero net NPLs? That almost sounds too good to be true. What does that tell us?
It tells us they have an extremely conservative and apparently highly effective approach to provisioning and risk management. The how is directly linked to their provisioning strength.
Meaning?
Their provision coverage ratio, or PCR, is now at 100.00%.
100% PCR. So for every single rupee they identify as potentially bad debt, the gross NPLs, they've already set aside a full rupee in provision.
Exactly. They are fully, completely provided for against all recognized credit risk on their books right now.
Yeah.
That's how gross NPLs of 0.22% become net NPLs of 0.000%.
That's incredibly prudent. And they manage this ultra-clean balance sheet while maintaining strong capital buffers, too.
Absolutely. Their capital adequacy ratio, the CRR, remains exceptionally strong at 56.60%. That's way, way above the regulatory minimum.
Huge buffer.
Huge buffer. And look at their leverage. The debt-to-equity ratio is still very conservative, trending down slightly to 0.82 to 1. This isn't a company stretching its balance sheet thin. It's built like a fortress right now.
Well, when you combine near zero net bad loans with that kind of capital strength and low leverage, it's probably no surprise what the credit rating agencies think.
Exactly. The ratings reflect that stability. They've got long-term ratings of A+ stable from Acute and Brickwork, and a stable from Care. And short-term is A1+1.
Yeah.
It all points to a very solid, well-managed institution.
That operational stability and conservative stance must give them a lot of confidence and flexibility for pursuing those new initiatives, like the AIF.
Precisely. They have the financial headroom. And one final point on security, they also disclose their security cover for debt holders. For their secured NCDs, the pari passu security cover ratio is 2.15.
Meaning the assets backing those bonds are worth more than twice the value of the bonds themselves. Plenty of security there, too.
Yep, solid all around on the risk front.
Okay, so let's try and pull this all together. Looking back at our mission for this deep dive, we've seen TFCI, this legacy lender with deep roots in hospitality.
Right, leveraging that expertise but not standing still. Executing a really disciplined diversification into areas like secured real estate, specific types of infrastructure, and structured finance.
And that disciplined strategy seems to be working, isn't it? We see robust profitability, that really impressive jump in net interest margin.
And crucially, exceptional asset quality. That near zero net NPL figure, backed by 100% provisioning in this first half of FY26, is quite remarkable.
It really is. Which brings us back, I think, to that potentially most significant strategic move they're making. the Alternative Investment Fund.
Yeah, the plan to co-sponsor and invest in that Category 2 AIF focused on hospitality and real estate.
So here's maybe the final thought, the question for you to mull over as you think about where TFCI goes next. Given how successfully they seem to have cleaned up their direct lending book, getting NPLs basically to zero, and this clear regulatory nod to move into sponsoring AIFs, are we actually watching TFCI subtly pivot its whole business model?
Interesting way to put it.
Is the grand plan maybe less about being a traditional capital-heavy direct lender and more about becoming a capital-light, fee-generating powerhouse in asset management and structured investments, leveraging their niche expertise?
That's definitely the multi-million-dollar question, isn't it?
Yeah.
Is this the start of a fundamental shift? Something for you to keep an eye on. That's the real story potentially emerging from behind these strong H1 numbers.
Definitely food for thought. Okay, that's our deep dive for today.
We'll catch you on the next one.